Hi, and welcome back, everyone. My name is Michael LeBlanc, Director and Senior Portfolio Manager at Canaccord Genuity Wealth Management. And welcome to our weekly live webinar where we talk about everything finance and keep you up to date on what's going on in the world and in the portfolios. As always, do keep in mind that the information we cover in here is really just for personal just keeping yourself personally up to date. Don't take it as advice or solicitation. Always do your own due diligence or seek the advice of a professional before applying any portfolio or financial plan strategies. We try to keep the information as up to date as possible, but it's always changing. So keep in mind to double check all facts and figures before moving forward. With that, as always, this is live, but your sound and videos are turned off, so feel free to move around. But if you want to ask a question, just click that Q&A button and you can type in the question. We'll try to get to it live here on the webinar, but if we can't, we will certainly follow up with you and answer all and any questions. If you're watching on the replay, just you see the link down below. You can go to mikeonmoney.com and reach out to us either phone, email, on any of our social media platforms. You'll also see our email address there where you can just email us any of your questions, and we're happy to answer all those as well. So let's dive right into things and see what's going on out there. So this week, we're waiting for the Chicago Fed National Activity Index to come out. So pretty light on the financial news in late August here. It tends to be a slow month, but we'll keep our ear to the ground as those things come out. This week, we also saw the U.S. coronavirus cases stay below 50,000, which is great news. It's still growing 50,000 a day, but slowing down, which is the trend we want to see. Still some hot spots we're watching and concerned about, but things are starting to reopen down there. And we'll keep a very close eye, obviously, as the schools all reopen. The FDA has authorized the convalescent plasma for use with COVID-19 as a treatment. Now, keep in mind, this is for emergency use. In fact, I know there was some comments by the U.S. government saying that this was a breakthrough and, very optimistic about this. But if you really listen to the FDA and the medical experts, really all this is, if you're not aware, is the plasma from people who've recovered from COVID. So the antibodies are in that plasma and they're using it on only emergency use. So very severe cases, kind of last minute treatment, and it's still not a proven that it really is effective. There's been no real deep dive studies. Early use of it without having any kind of placebo group or proper study being done has shown that it's helped in some cases, but not widespread. So FBA is being very reserved about this, and also the very limited supply because it has to, of course, come from blood donations from people who have recently recovered from COVID-19. So that is happening, but do keep in mind it's still really early stages and not being widely used currently. Many companies are looking at postponing their office reopenings. No big surprise there. I mean, if anyone here on the call are working in our office environment, they've probably seen their offices still not open, and some offices are even starting to say they're not even going to attempt until January 1st. I know our office, I'm in the office today, starting to work, 1 day a week, sometimes 2 days a week in the office. There's really limited staff that's allowed in any one time. There's a lot of protocols to follow, limited people in elevators. So I think there'll be probably much later in the year, if not to the new year, before we really see offices opening up. And that's just as they figure out how to handle full people, not just in the buildings, the elevators, sitting arrangements, whether they need more screens or need to space people out more. It's all going to take a bit more time before I think we get back to even considering reopening the offices completely. Let's take a look on what's going on out there in the analysis world. So Wall Street Wall Street's really looking at the Fed for some, the Federal Reserve for some direction on how we're going to come out of this economically. There's been a lot of stimulus, been a lot of money spent, a lot of money pumped into the economy. We've had interest rate massively cuts. How are we going to build out of this? How is the economy going to build? How are they going to deal with inflation? So we're really looking forward here in the next few weeks to hopefully hear something from Mr. Powell on what the plan is and what direction they're going to take the Federal Reserve in the U.S. COVID-19, the news is COVID-19 has a black hole around the compensation fund for pandemic vaccines. Of course, vaccines are in the news a lot. We're looking for, the developments. Russia, as we mentioned last week, just coming out with theirs. Several in North America and in Europe going into phase 3 testing, so this human testing. So there is a government fund set up to compensate people who volunteer for the vaccines and experience some negative side effect. Some concerns from lawyers who are out there representing some of those early volunteers, that only 10% of the claims have been awarded or responded to. So a lot of concerns how that's going to play out here in the next couple of months, as many vaccine producers are starting to go into that phase 3 in September here. So we'll keep an eye on that. U.S. oil inventories are looking a little bit better. So this is, as we talked about since we saw the crash of oil pricing in May, the oil inventory, the oil reserves were pretty much full. There's nowhere left to put oil. So there was a big cut in production of oil globally. We'll talk a little bit about the OPEC plus meeting that happened last week. But the oil reserves in the U.S., or the oil storage in the U.S., started to ease up a little bit more breathing room, which puts a little bit of life back into the oil market, but that is only due to the massive cuts on the supply side, which could easily be ramped back up again, and those reserves and storage could be filled back up again. So wouldn't look at too much strength in the oil sector, but that's something to keep an eye on as well. Other headlines out there, the U.S. Business activities are moving up positively. Remember, we're coming off a pretty big low, and we do have some of that pent-up demand as we're seeing an early surge. But that is still positive news as we see some strength coming in there. Home sales, of course, continue to surge, same as we're seeing here in Canada. Again, that is a little bit due to supply being down as people are tentative to sell, so the limited amount of supply. And low interest rates. We're seeing massive amounts of not just buying on low interest rates, but refinancing of current mortgages at lower rates, as we're at historic lows as far as interest rates go. So that's keeping those two areas moving, which is good for the economy as long as we can maintain it. Really what we're looking for is this unemployment numbers to start dropping, because without unemployment numbers improving, then the economy can't really start to recover with people out of work. House sales will eventually slow down, and so will business activities as people don't have the extra money to spend, especially when the stimulus packages dry up. The US and the EU came out and hatched a mini deal kind of quietly to remove tariffs on about 200 million of products, including lobsters. So, great for anyone who wants to end the summer with a nice big lobster fest. Although you probably would bring it in from the Atlantic Canada and save all the tariffs, but they did strike a deal in the U.S. Where they can access some European products without those extra tariffs, which is a positive move to hear on the trade front, that the U.S. is shoring up some relationships around the world, since they still have problems with massive problems with China, and of course with the UK with Brexit coming up. Competition heats up in the U.S. stock exchange area. So if you're not aware, it's been a trend over the last few years for more electronic exchanges, so alternative exchanges to crop up. We've got a couple here in Canada and a few new ones coming out in September in the U.S. to compete with the U.S. Stock Exchange and NASDAQ. And that's, we've seen some really high trading volumes through all this. And it means big profits for those exchanges, and some of the smaller electronic exchanges are coming in to try to benefit from that extra volume and maybe take a little bit of market share from them. As mentioned, OPEC plus countries met this week to talk about the supply reductions that everyone promised. And the big topic of conversation was really the reductions that were supposed to be done from May to July. There were some countries that did not live up to those limited numbers. And we talked in previous webinars and videos about the fact that some countries weren't going to be able to live up to those because they rely on that income, especially in this time of shutdowns where they really need that income. They were going to outproduce, and that's what's happened. So they've been kind of told to slash their production over the next 2 months by about 1 million barrels per day to catch up or compensate for the amount that they pumped out over the last few months. And we'll see if that, that follows through. Probably not likely. Again, the countries really need that revenue. So the likelihood of that happening is low, and could even get worse depending on how things progress from here. So again, just some more downwards pressure on the oil pricing. We look at the numbers around the world. The world numbers, just shy of 24 million cases, 814,000 deaths. US, as we mentioned, slowing a little bit, which is good. Still at 5.88 million infected, 180,000 deaths. Canada, unfortunately, I cut it off on the bottom of the chart, but just over 9,000 deaths. Starting to see a surge everywhere, BC, Ontario. Really probably some overconfidence. People get out there and are a little too aggressive in the resocialization, not following all the recommended guidelines. And of course, we have schools reopening soon. So we'll keep a very close eye on those. And hopefully we don't see some extra shutdowns. As you're probably aware, BC announced extra fines that they're putting for large groups or individuals who are violating the recommended protocols. So we'll see how that unfolds with some early fines already being issued. Let's take a look at the economy. Pretty upbeat in the US, the economic data, the S&P 500 and NASDAQ both closing at record highs. The dollar rose against the euro, slight weakness against Canada. Gold prices slipped slightly, not much, but a little bit. And oil prices were up and down, actually down end of last week, up again yesterday, just slightly. We're talking pennies here. But overall, fairly positive. A lot of concern around that. Let's keep everything in check. We've got the markets at all-time price earnings numbers or valuations in the U.S. While the economy has shrank. In fact, we heard this week coming out of the U.S. the GDP in the second quarter shrank by 32.6%. Massive, bigger shrinkage on the GDP than during the Great Depression, and yet we've got markets at all times high. That's a big disconnect from the economy. Obviously not sustainable. The markets cannot continue to grow at those rates or maintain those rates unless the economy does a massive turnaround really quickly, and that's probably not the card. So we've talked about in previous weeks, trimming profitable stocks, staying in the market. I mean, there's still some good areas to focus on. We'll talk about that a bit when we talk about tactical invested, but do keep in mind that, those valuations are not reflective of what's happening in the economy, and really have to keep that in check. We mentioned jobless, the initial, since last week, the job numbers came out and they were higher than expected, over the million mark, which they really wanted it to fall below that. And the week ending the 17th, again, 1.1 million. So still high on the unemployment claims on a weekly basis. The job numbers are coming in lower than expected. The early numbers came out higher than expected, but now they're tapering off. As there's that big pent-up demand, a surge of hiring as things started to reopen. But now we're seeing more close downs, slower reopenings, and a lot less staff going back for those openings as volumes are lower than they were. So again, with those unemployment numbers staying high, still a big concern around the economy. And of course, the markets. The consumer price index edged up slightly in July. And again, that's the inflation. All that printing of money by the governments is going to drive that. We know that. We just want to make sure it's at a gradual rate. And so far, good. And that's where we're seeing the strength in gold kind of hedge against that inflation number. The confidence number, the confidence indexes are all high. Some of them on record levels. Again, big concern there. Just a little bit more overconfidence, both in the markets and in the economy. We're really not seeing the economic numbers to support those things. Usually when we see the confidence numbers that high, disconnected from the economic numbers, it's a bubble, right? We're going to see that pop come. We're going to see the some investors get hurt, and we hate to see that. So, again, it's really to be cautious about your risk factors. And that's why we want to talk about tactical investing later in today's presentation. Housing numbers, as mentioned, were strong, which is good for everybody. And hopefully we see some of that continuing. Obviously, we need the job numbers to improve for people to keep buying houses, but with low interest rates, there is still a lot of activity out there. So top news in the US, Facebook and all social media. We talked to previous about Twitter, being really conscious and trying to put in ways to block political ads or misinformation, surrounding the election coming up. Facebook was at the center of the investigation on the 2016 Russia influence over the election, and they're trying to put things in place to prevent that for this round. Obviously, there's a lot of sources out there, even the U.S. government, not our government, putting information out regarding the U.S. election, and whether they're taking those ads down, blocking them, or just putting warnings on them. All social media companies are being pretty diligent about trying to keep people properly educated on what the truth is out there. John Deere company hit record highs on their stocks and their earnings as they upgrade their forecast. We mentioned last week that they were going to be announcing some great sales numbers, some great revenue numbers, as a lot of investment went back into replacement and big demand on precision agriculture technology. And this is tracking your agriculture basically from crop to table, keeping track of where it's grown, where it gets distributed, and what retailer it goes to your table. So great technology. In fact, I think if anyone's conscious about where their food's coming, what quality of food they have, that's an area that I think we're only going to see expand in the near future. Fearing the shipping crunch. So retailers are announcing that they're going to do their holiday sales much earlier this year over fear of increased demand for shipping and longer shipping times. If last year was any indication, as we mentioned in previous webinars, last holiday season was a record number of online sales versus in-store sales. And obviously this year's probably going to blow that record out of the water. And shipping companies are already talking about a surcharge for the holiday season due to increased volume and demand. So the retailers are now starting to try to get ahead of the game, expecting longer lead times to get packages to you. And the sales are going to come a bit earlier. So look at doing your holiday shopping a bit earlier than normal. I'm usually one of those last minute people, so I'm going to have to get on top of that, as my wife usually tries to be done before November 1st, so she always outdoes me on that. Nearly a fifth of enrollees into Pfizer's vaccine volunteers, the test trials of the 30,000, 11,000 people are of minority, which is great news. It's very important since they're the largest group being affected by the virus. So having them part of the testing group will give us a much better results. So that, as I mentioned, a lot of the vaccine companies going ahead with in-person trials, and Pfizer's being one of them, moving forward with that as well. Amazon's getting a new CEO as Jeff Wilk is stepping down later this year. I guess he just made enough money and decided to retire. He was in line to, or one of the people in line to possibly take over for Jeff Bezos, but he's decided to retire and pass the torch. So we'll keep an eye on who's going to take over there. Up in Canada, nothing major on the economic front coming this week. As I mentioned, August is a slower month for economic news. That's okay. No surprises is good as well. Canada's retail numbers jumped above June's numbers, which is great. We're still seeing some increase in that surge. Most of the increase came from motor vehicle and parts. And again, that's just that some of that pent up demand as people couldn't buy cars. You know, a lot of dealerships weren't doing test drives or having people in the showrooms, and obviously people put off servicing their vehicles while everything was shut down. So as that reopens, we saw a big surge there. On the financial front, TD's got ordered to pay a big fine, $122 million, for their overdraft and practices. Basically, they were charging people in the U.S. consumers an overdraft fee, which they had not disclosed. So they had to pay $97 million in restitution and $25 million in civil penalties. Scotiabank, actually, funny enough, also had to pay roughly the same amount, $127 million, I think it was, in fees to U.S. Over some trading practices that they did down there. So a couple of Canadian banks taking some penalties over the last couple of weeks. Canada's IM Gold. So we've been following the gold sector, of course, and there's been a lot of mergers and acquisitions. And IM Gold was looking at buying a mine in Mali, which of course is being delayed due to the political unrest in the area. Still look like it might continue, but they're just taking a step back while they figure out how that's all going to play out. On the foreign exchange front, the US dollar weakened a bit, is expecting to weaken a bit more in 2020. We've been following this all through COVID. It's been fairly volatile. We do expect it to move with market sentiment. So the more optimistic, as we mentioned, that confidence factor is an all-time high, so it's going to push the dollar down. If we see a reverse trend there, we'll see the dollar strengthen again. So definitely seeing some continued weakness there, although we're also seeing some weakness over on the pound as the Brexit negotiations aren't exactly going in a positive manner. And until that gets resolved, probably continued pressure on the European indexes, or the European currencies as well, as they solve that situation. Oil, on the other hand, as we mentioned, kind of staying flat, no real upward pressure, a little bit of movement to the upside. We're talking pennies here. The futures, the West Texas futures, kind of finishing off at 42.62. And that's really due to the shutdown. Whenever we've got two storms headed into the Gulf in the U.S., and Texas, of course, has to shut down all their gas and oil outputs in the area to protect it from any storm surge. So just a little bit of upwards pressure from that. But as soon as the storms pass, those will reopen again. And mentioning gold, just hovering below the 2,000 troy ounce is expected to go to rally to the 23 to 26 range, just on those inflationary pressures. So let's talk about tactical asset allocation. I've been asked a lot about this lately because every week I tend to talk a bit about how we manage money, how going into COVID, we were about 35% cash, or cash equivalent, I should say, because it was invested, but in interest-bearing, guaranteed type of investments in order to protect against a possible pullback in the markets. Versus, kind of the traditional buy and hold strategy. So we've done a couple of videos. I recommend you go take a look at the 60-40 strategy, which is kind of your balanced buy and hold strategy. And we talk about why that's probably not a great strategy to use anymore. It was based on some, not bad data or bad information. It was just out of date. Things are different now. Markets move differently. The economies are certainly in a completely different situation currently, that really wouldn't recommend that buy and hold. And simply to paraphrase a little bit of what you can see more in those videos is, if you do a buy and hold, COVID, the lows of March would have been a great example where we saw the markets fall about 34% in March. And then, as we mentioned today, they're back up again. But math doesn't work in the sense that if you go down 34% and then you go back up 34%, you're not at break even. Basically because the plus 34% is off a much lower capital amount, right? Because you lost going down. So you have a smaller number earning that 34% on the way up. So you don't break even. The strategy around tactical is really not to market time. Don't think of this as I'm going to move to cash to equities on a daily basis. It's really not what we try to do. We look at longer term trends. We look at longer term risk components in a portfolio, and we try to avoid big impacts. So a good example is our portfolios late last year. We saw a lot of risk in the market, not even counting COVID. And we saw it in, potential recession triggers could have been coming for 2020. So what we did is we did happen to raise kind of the guaranteed side of things, not in fixed income or bonds, because we didn't like those positions either. We went into kind of more guaranteed short-term investments, and we moved away from consumer discretionary. So that's things people buy when times are good. So we moved away from travel, we moved away from retail, we moved away from things like restaurants, because those are luxury items that people buy when the economies are good. We moved into consumer discretionary. We moved out of consumer discretionary, we moved into consumer staples, which is your grocery stores, your power companies, things that people use regardless, right? That people need, even when the economies are bad. So we didn't get out of the market. We didn't time the market. The cash we built up was really just a byproduct of we couldn't find anything at a value that we wanted to buy. So things were just too expensive. So we didn't want to get out of the market. We just shifted what sectors we're in. So that's really important, because when you talk about tactical, some funds and some portfolios will just move strictly between fixed income and equity. So they take on more risk and go what they perceive as less risk, and we'll talk a bit about that. But they won't actually shift within sectors. So our approach is really to also do a sector shift to protect. So if you look at the market as a broad, what you see in the news, the S&P 500 or the TSX indexes, those are very broad indexes. And I always tell people, don't be afraid of what you hear in the news, because your portfolio could be going up while those are going down, just by which areas of the market that you're invested into. Some areas of those markets are more aggressive. They are more volatile. They do carry more risk. Some are much less. And you can definitely shift your portfolios dependent on your own personal risk profiles or what you perceive as being the longer term trend in the economy, and still take advantage of growth without taking on all the risk of the market. You can limit that risk. So it's not market timing. It is shifting within those different categories. Now, as I mentioned, fixed income, a lot of, the standard view of that is it is lower risk, but those are bonds, and bonds can fluctuate into the negative, especially the longer term you go out, and dependent on the interest rate market. And inflationary market with rising interest rates is a bad market for long-term fixed income. So using just fixed income as your safe haven might not be as safe as you think it is. So it's really important that your fixed income or your safe portion of the portfolio is managed properly as well. You want to go into areas that are not going to be negatively impacted by the longer term trend. There might be a little bit of volatility, but if your longer term trend is in line with your strategy, you'll do fine. And really look for those positive bumps where you can in that protected area of the market or of your portfolio. So take advantage of that. Now, within the equity side of things, again, I've mentioned, consumer discretionaries, consumer staples. There's other areas of the market that you can also take advantage of. We've talked about technology can be quite volatile. Doesn't mean all technology is bad. We have, even in our protective stance, a great position in cyber technology. So this is the cyber technology companies that are producing the defense for companies as they invest in protecting their databases. This is a trend we started almost 2 years ago we've had in the portfolio. It's been an amazing performer. And certainly through this COVID, it's only even gotten better. As more and more companies and governments have to spend a lot of money on protecting from cyber attacks, as more and more people work remotely. That means more computers to protect, more communication lines to protect, more investment being made in that area. So there are, pockets. We talked about gold. We have it in the portfolio. It's a great hedge against inflation. It's performed amazingly well through all this. You can still have equity positions that are outperforming while not necessarily at risk of the underlying overall market movement. So make sure when you're building a tactical asset allocation strategy that you're not only looking at your risk on versus risk off, but also really, really looking at what you have in that risk on and the risk off. As you mentioned, fixed income can carry risk. So do make sure that you've got the right exposures at the right times. Buy and hold, don't recommend. Don't market time. Really look at their longer term trends, but shift with those trends and make sure that you're comfortable with the risk that you're carrying and the volatility that's in that portfolio. With that, as I mentioned, I have some deeper dives into these strategies. I recommend you go to our YouTube channel. You can see those. If you want to see where to go there, go to mikeonmoney.com. You can see all our channels there. Do reach out to us if you have any questions about your portfolio, if you want us to do a review, answer any of your questions. Give us a call, email us. You can book an appointment right on our website at mikeonmoney.com. Subscribe to our channel. And if you have any questions or you want us to take a deeper dive into anything, any topic you've heard here or any topic you hear out there, always let us know. We're always happy to answer those questions and bring more information to you. With that, I'll say thank you very much, and I'll see you next Tuesday at noon as we do our weekly live. And remember, every Friday we put out our deep dive, and this week we're putting out another one on how to get started with investment of just $5,000. So any younger people or people who just want to start getting into the market, we've got some tips for you there. With that, take care, and we'll talk soon. Thank you.